Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the economy and we take a look at investing. I'm Stacy Smith, and I urge you to subscribe or say that you like this podcast on whatever platform you happen to be using. Well, at the annual Jackson Hole meeting, Jerome Powell had a lot to say about employment, inflation, and interest rates. My panel of financial advisors and experts will give their opinions on what he had to say and how it might affect the economy and your portfolio. Oh, second quarter earnings reports are also coming in. It is coming up in this edition of The Bull, the Bear, and You. Well, so much for those lazy, hazy, crazy days of summer. Well, maybe crazy still applies. If you've watched or listened to this podcast in the past, you know that my panelists have always said they are more interested in what the Fed chair has to say and use it as a guide as to what action the Fed may take down the road. My panelists are not alone, as Wall Street is deciphering what the Fed chair had to say at the annual Jackson Hole gathering on Friday. Now, what the Fed chair had to say, along with some earnings reports, sent the markets higher, with the Dow setting a new all-time closing high on Friday. It took only about 8 months to do that. So let me ask about earnings first. Kim, how are they shaping up and so far this second quarter?
Sure. Well, I think this is probably an overused expression, but I like it. The earnings are better than feared. I think people were really apprehensive about what the tariffs would do on costs and how that would play out, and then what it would do for demand and looking forward. And the better than feared part is really about guidance, that companies probably set a low enough bar for this year at the beginning of the year, and they're kind of maintaining that. Although recently there are some tariff costs bubbling up, and it's exactly where you would think Walmart, right? And stores of that ilk that import a lot of goods. And actually, I have to say, as somebody who does the household shopping for us, for my family, vegetable prices, fruits and vegetables have just gone through the roof. So I think that is another Trump administration byproduct by, ushering out a whole lot of illegal aliens, or whatever you want to call them. I don't know, people who aren't citizens, non-citizens. We'll do that. So these things are showing up in earnings, but not in a way necessarily that makes the companies, seriously knock down their estimates. So better than feared. I think that's what I want to stick with.
I would say that, what Kim is saying is exactly what obviously we've been seeing. But the concern lies ahead. It lies in the fact that these tariffs, and some of them really just took effect, and what impact will that have throughout the rest of the year. I think it's fascinating, though, to think about that a little bit more and understand consumer behavior. That if you go to Walmart and you're going to buy something that has gone up in price because it's been imported, are you going to change your behavior and now shift to a different product that maybe is manufactured here in the U.S. when you think about it, that maybe hasn't seen the same price increase? We see that with food. People start buying ground meat instead of fillets, things like that. So there will be, as always, again, another overused term in our industry, there will be winners and losers.
That being said, the earnings were good, though, right, Kim?
Yeah.
They're up maybe 13% from last year in the second quarter, and the guidance is reasonable, and it looks as though they've been absorbing tariffs at the retail level, or the corporations have, but that won't continue. Eventually, they will pass it on in some manner to the consumer, and that's the hedge that's out there worried about inflation.
Yeah, I think you guys point out the earnings were good. Things in the economy generally look okay, but the market's going to end up caring about, are things getting better or are they getting worse? And I think as we go into the back half of the year, I don't necessarily want to say cracks are starting to emerge, but the potential for cracks to emerge are certainly there, regardless whether it's tariffs, whether it's the job situation. You know, if the Fed, I know we'll probably talk about this later, but the Fed cuts 25 basis points or so, is that really going to make a difference in terms of whether companies begin hiring more and you know, borrowing more to build out their businesses, et cetera? So, you know, we're very, very cautiously optimistic here going forward. Hope, you know, very cautiously optimistic, I should say.
Would it be that the guidance from these companies is not necessarily bad? In fact, if it's kind of holding steady, is that because they know they can just raise the prices and they expect people to pay it? Because where else are they going to go? If indeed the tariffs do cause inflation here.
I think there's some of that, but I think what they're really seeing is what effect tariffs are having. And again, like Walmart, that has, if you walk through there, not necessarily, well, they're hard goods, right? You know, the stuff for the home, the stuff for the garden, the stuff for your car, a lot of that comes from China. But there's a lot of stuff in that building that does not come from China. And the proportion of imported goods is, for the economy, relatively low. I believe it's something at like 13% of the total goods that we use in a year are imported. So while it's overly weighted in things like cars and furnishings for your home, you know, we buy a lot of stuff that gets distributed. And I think that's what we're seeing is the tariffs are having an effect, but it's not across the board equally. And you know, companies can absorb some of that, pass some of that along, and I think they've seen their way to be able to manage it without, you know, showing a drop off. Because what they're doing is looking at what they think forward demand is for their products as well, which that's super interesting to me. They don't see demand diminishing, so they don't have to lower their earnings.
Now, we're talking basically now about larger companies. If I'm not mistaken, the Russell 2000 jumped up after the Fed chair had his comments on, what was it, on Friday. I may be wrong which day it went up, but it did go up. Where I'm going with this is that the bigger companies might be able to you know, hold the line a little bit, but the smaller companies that do import products as well, how are they going to fare with this?
Well, I'll jump in real quick because I love small companies. Well, a couple of things. Firstly, what I think that really reflects is the interest rate environment, not necessarily demand for products from the smaller companies. The thought is, just at a broader brush, these are smaller companies, they depend more on debt, and a lower interest rate environment will let their revolving debt, which is kind of like a credit card for companies, you know, they don't have long-term debt like or they're not able to lock in longer-term debt. It's revolving debt. So the current Fed environment is very much reflected in the interest rate environment, and small companies are more affected by that. But also, I think it opens up the door for mergers and acquisitions, which is a reason to want to own smaller companies because they are often the subject of a merger.
Okay, good. Well, let's move on then here to also some other comments from the Fed chair on Friday. Perhaps the most troublesome area is where the labor markets stand, and Powell called it curious. Michael, can you explain why this is curious and why what his statements are and what is happening with the labor market is sounding some alarm bells for people?
Sure. So I think he said it was in a curious kind of balance or something like that.
Something like that, yeah.
And what he means by that is we're in a slowdown in both the supply of labor and the demand for workers. So as we all know, and Kim kind of talked about before, we have shrunken the supply of workers because of, you know, the immigration policies that the presidential administration has enacted, and that is counteracting the effects of general just reduced demand for workers. And so that is, you know, you can look at it as like that's leaving the unemployment rate relatively low as a result, but I don't think that's a really healthy unemployment number that we have. And for now, we've talked about this before, employers just aren't laying off as many workers, right? we are in a situation where I think employers seem to be in a don't hire, don't fire mindset. And the risk is that with hiring so low, even a modest increase in layoffs could lead to significant job layoffs in the US, especially if hiring remains very low. So I think that's what the Fed is really kind of worried about is anytime you start to see layoffs start to creep up, it's kind of a cycle that's really hard to get out of. I mean, it just continues to sort of spiral out of control. And we talked about the Fed having a dual mandate, right? They want to keep prices stable and they want to keep unemployment, they want to keep the employment level at full employment. So full employment. But they certainly seem to care about one more than the other. They certainly seem to care about keeping the employment situation very, very healthy and maintaining a full level of employment in the US. Even if that's to the detriment of inflation. So they're in a precarious situation here, I think. If they start to cut too aggressively, that could, stimulate or fan the flames of inflation further. But as of now, they really are getting kind of worried, I think, about the labor situation.
Yeah, I think that they're very, the labor markets really have shown some cracks. And as Michael was saying, you have layoffs and you really need job creation just to absorb new workers coming into the workforce. And kids coming out of college these days are having a heck of a time finding a job. There's articles all over the place that talk about, kids sending out hundreds of applications and not hearing anything because you don't have a lot of mobility. You don't have a lot of mobility in general. Like it's actually one of the things that is affecting the housing market because people aren't moving. They're everyone's just kind of staying put. I'm staying in my job. I'm staying in my house. And, that has impact on an economy that's used to people in motion because it means money's in motion. So, we've talked about this before. Like, I'm going to be moving at the end of the month. I can guarantee you that I'm going to be at Home Depot every day for like 90 days straight. So you need that kind of mobility. And if people aren't changing their jobs, they kind of just stay put.
Add to that, with the employment situation, we have about 10,000 baby boomers every day retiring. And that's going to go on, maybe not to that degree, because I don't know how the population of baby boomers is spread around the different ages, but the youngest of the baby boomers were born in 1964, and those people are only 61, and full retirement is still 67, which means there's 6 years more of this retirement that's going on in a big way that shrinks the labor market. So those young people eventually will get a job. The problem is they have no experience.
Let me throw on one more part of this that I read something over the weekend, and that is that we may be facing a net decrease in the number of immigrants to this country, whether they be legal or illegal. And because I think they're estimating 1.5 million immigrants will be leaving the United States this year with the deportation or the mandates that the president has put into effect, his administration. And so, how is that going to affect everything? You already said that the price of vegetables and fruits and everything, Kim, have gone up.
So let me just toss this out there, because I am an equity analyst at heart, which means I think good things happen all the time. I'm not a bond person that thinks everything is going in the dump and you have to figure out how you're going to survive. So I'm totally not kidding. This is like the two divides of Wall Street, right? So on a very best day, what I would love to see, this is so crazy, and this is probably for your other show, Stacey. How about we get Congress to have a cogent immigration policy? How about that? That we use technology, that we know who's coming in and we know why they're coming in, as opposed to oh, I'm sorry, you have to fill out all this actual physical paperwork and then wait years and years to be with weird special rules. If we could solve that problem, maybe we could correct the whole problem. I don't know. It just seems like something that Congress needs to do?
Maybe the other thing I'll throw out here, and I don't know if anybody can comment on it or not, because I don't know how often you hire, but I'm hearing that the applications that are going through AIs, companies that are using some sort of format to ferret out who they want to talk to and everything. People are not hearing back anything. There's not any progress going on at all. Carrie, you're shaking your head. You understand what I'm talking about here?
Yeah, it's all algorithms. And, the best thing that I could recommend for someone that's looking for a job is to hire a coach, someone that understands these algorithms, because when you send your application in, there's not a person looking at that. So there are people out there, and, outplacements or whatever services are out there to help you to craft a resume and a cover letter that will help get you through the algorithm.
To be fair, I mean, I ran into this problem personally like 15, 16 years ago or so when I moved to New York. I mean, it's hard to get a job going in cold, in my opinion. If you don't know somebody there, if you can't have a connection, a warm lead, it's always been difficult, in my opinion, to get a job. And I don't think that's really changed today versus 20 years ago or so for the most part. Yeah, I do think you guys are all right in terms of kids these days have a harder time getting into it, especially because of this work from home thing that we are constantly in. Outside of me, every time I'm on this program, you see I'm in my office. I'm a 5-day-a-weeker, have been since COVID, so I'll stand that ground. But I think from a working standpoint for young kids, I mean they have a lot of uphill battles to fight.
As
young
did
people
I
these-
when I came out of college. It was a difficult time in the early 70s. You remember that, Stacy? And I got my first job because I knew somebody. And he came after me. I thought I was going to get drafted, but fortunately for me, I didn't, and probably for the country as well.
Okay. We'll move on here. Carrie, there was an article from Bloomberg on Sunday that said that Powell's comments on Friday about the probability of interest rate cuts in September has eased the worries about some AI stocks being overvalued and has now put the focus on Wednesday when NVIDIA reports its earnings. So why would a rate cut make any difference to the value of AI stocks?
Well, I mean, it kind of goes back to something that Kim said earlier about small cap stocks. A lot of these companies do borrow money to fuel their R&D. And so lower interest rates gives them, less interest expense across the board. So that's one element of it. The other element of it is that, again, Kim's probably better versed at this than I. But when you look at future cash flows, valuations are based on the future cash flow of a company. And that interest rates going down actually boosts the present value of those future cash flows. So therefore, the valuations can be better justified. And then I think the third thing really is that when interest rates go down, the purpose of interest rates going down is to stimulate the economy. So, the idea is that you're going to have more economic activity. Now, let me caution you. This market really loved what Powell had to say last week. There is another overused saying in this industry, which is buy on the rumor, sell on the news. So heading into September, there are people that now want to get in because they're like, oh, he's going to lower rates. Well, the market's already anticipated that. I think that what's going to be more interesting and, a rate increase, or a rate decrease, if it's done too soon, can actually send longer term interest rates up. Because if the market views it as being overdone, like let's say he cuts 0.5% instead of 0.25%, the market might take that in two ways. It might take it as though, while he overdid it, the economy actually isn't that bad, and this is going to this is going to, kind of overstimulate the economy, which will drive interest rates up. If the other way that the market might look at it, based on his comments and the data that's coming in, is that things are actually worse than expected. If he lowers 0.5%, is he lowering because things are really bad and so we need to sell? So you never know what's going to happen the day that it actually happens. And a lot of it is based on comments relative to the actual data. So it's always a very exciting day for all of us in this industry. The other thing I'll point out about where we are with the markets, volumes in August have been very low. So, that's why we always say after Labor Day, put on your seatbelt, because people are back, they're focused, they're trading. And these little kind of headlines that may sway the market in a direction, maybe oversway it, kind of come back to reality as we head into the fall.
And to add a fourth thing, the competitive between the part that Kim likes, the equity markets, and the bond market, which are the negative people, if interest rates fall, bonds become less attractive and the money has to go somewhere. So some of that money will leave bonds because the risk-reward relationship gets out of whack. And we'll move to equities, because if you're going to take that much risk, you might have a better opportunity to make more than 4% or wherever they settle in at on the bond market. So all these things play. It's not a simple thing. There's a lot of moving parts that connect.
If it were simple, AI could figure it out.
Only a matter of time, Kim. Only a matter of time.
Yeah.
All right, so let me get to this one now, since we've talked about interest rates. Frank, as we mentioned, Powell did hint that the Fed might lower interest rates in September. We still have some inflation reports due in and employment numbers before we hit September, mid-September, when the Fed meets again. But if indeed rates are lowered, even a 0.25% or whatever it might be, which bonds are most likely to see their yield decrease and then the price go up? And will this have any effect on a major part of the economy, the housing market?
Kim kind of alluded to something that I'm going to take another step to. Understand that the Federal Reserve controls the overnight interest rate and nothing else. That's the money, that is the amount of interest that banks pay each other when they lend each other money until tomorrow. All right. That being said, they certainly have an influence on the other interest rates. But interestingly enough, the 10-year bond barely went down when this announced. It had already gone down in anticipation of what Powell basically confirmed on Friday. That being said, I have a thought that I haven't gone through fully in my mind yet, but I'm sitting here thinking, if interest rates go down and we have full employment, we'll have inflation, which will cause longer-term interest rates to rise, and we have begun to get a steepening of the yield curve, which means the shorter rates pay less and the longer rates pay more, and they'll pay even more. And there's a pivot point, usually around the 5, 7, or 10-year maturities, which at those points, those rates might start rising, which will negatively impact mortgage rates because they are pegged on the 10-year mortgage, not the overnight rate, the 10-year mortgage. And if that rate starts to rise because of fear of inflation, which Powell's more concerned about employment today, that could change next week. As the data rolls in. That being said, I wouldn't make any big assumptions about anything relative to interest rates and housing. I would say that housing costs are too high, and that's the biggest problem, a big problem. The second big problem was what Carrie said earlier in the show. People aren't moving. Everybody's hunkered down in the house they're in, so there's not a lot of movement of homes. However, last week, existing home sales were up. That's one bullet point, one point in time, and it may be meaningless over time because you can't look at one. This week, we're going to get new housing starts or sales, and we'll see how that goes. All right, and if housing starts moving around, as Carrie eloquently pointed out earlier in the show, a lot of movement starts happening. People buy furniture, people buy shovels, people buy all sorts of stuff, and that's great for the economy if people are moving.
Frank brings up a good point. I think the common thesis right now in the markets is that we're going to be in what's kind of called a bull steepener, which is when the short-term rates come down, but they come down more so than the long-term rates, and you get those long-term rates not really moving that much. I think what the Powell is kind of thinking, and maybe what some people are overlooking, is the inflation impact that we've been talking about from tariffs. Is that really a sort of a one-time kind of price increase, or is this going to be persistent inflation? Because if it's kind of one time, then you're not going to have inflation really materially going higher after those comps kind of roll off. So I think that's kind of what we're looking for, and what Powell's kind of, I think he thinks it's more transitory and going to be one time than it's going to be a persistent level of inflation there.
I'm not sure he wants to hear that word transitory.
Anymore? Yeah, he might have. We'll see how that plays out for him going forward. But and from a housing standpoint, Frank, I mean, there are so many issues regarding housing. I don't really see a situation where the housing costs really decline materially. I mean, I know Kim's trying to solve all of Washington's problems, and I can pile onto that right now as well. I think, if I'm not mistaken, in other countries, you can sort of transport your mortgage rate when you buy a new home. Meaning, if I have a 3% rate on my house now, if I go and buy a new house, I can use that and go to my new, when I purchase a new home. I mean, that could solve a lot of problems here right now too. So if you want to send this out to Washington D.C. in terms of what our thoughts are here, and then we'll see if our congressional affiliates can move this through Congress, I think we could solve a lot of problems today.
Yeah, I think that we have such a major impact on all of this.
Yeah, we do.
Michael, banks weep when you send in your mortgage payment.
I know.
We're making them cry.
I know.
Yeah, that would be a tough sell, I think. I could see the banking or the mortgage lobby, coming back hard on that one.
Hey,
but it would be an answer.
It's
no
being
doubt.
done elsewhere.
Yeah.
Long ago, when I first bought a house, there were these things called assumable mortgages,
Yes.
where you could buy a house and assume the prior owner's mortgage. That kind of went away after interest rates went down in the 80s, because nobody wanted to assume a 12% mortgage rate, and no bank wanted to let you assume a 6% mortgage number, which, although today they would love to.
Let me throw this one out. Carrie, I'm going to ask you, we have just a couple of minutes left, in the move by the federal government to invest in a company, in this particular case is Intel. I'm not going to have you talk about Intel, but as a financial advisor and you take a look at these sort of things, does that play any part in whether you would go into a company? Again, I'm not talking about one particular company, because we had this happen in 2008 as well, that the government came in and bailed out the financial institutions. This one seems a little bit different. They're calling for national security purposes. But what's your thought on that?
Yeah, I mean, I don't really love the idea of it because, we're all capitalists, right? And you kind of start blending the lines between, analyzing different stocks, and is a company that has an investment from the government going to have a competitive advantage versus another company that does not. It seems a little too close for comfort for me. You're kind of taking something that's government backed and putting it in a capitalist wrapper or vice versa. And I think it comes with some challenges.
But it's happened before. The railroad industry was invested heavily back 100 years ago. From time to time, the government has stepped in to energize industries they thought were important. And right now they think chips and making them here is important. And so they're going to energize Intel, for example, and maybe some others before it's all said and done. because they think it's important that we manufacture chips domestically. That's above my pay grade. I can't say whether that's good or bad. I'm not comfortable with the government getting involved, but I understand why they're doing it.
Yeah, that's probably above your pay grade, Frank. That's at my pay grade, so I'll comment on that. I kind of agree with Kerry. I don't like it. I mean, there's ways I think you can go about making regulations so we can have the chips designed here, but to take ownership stake in one company, that's walking a fine line between capitalism and socialism, probably. And that's something that kind of worries me a little bit longer term.
And here I'll be cleanup batter here. I actually, in the portfolios I run, own Intel. And I was holding on to it in the hopes that it would break into and realize value from, separating the two businesses, which is it has a foundry business and it also has a chip design business. That being said, I'm not thrilled that the government has ownership stake, but I also have been one of the few people, and you can look for appearances on other networks here, talking about how dumb it is to have the only place on earth that creates these extremely high tech chips that are used in our military devices on an island that's 60 miles from mainland China. Dumb, dumb, dumb. Oh, and by the way, lots of earthquakes. So not optimal to have one location for these chips. And, the administration
changing, right?
did try to incent people with tariffs, right? Because there was some idea floated out, like in 18 months, if you weren't importing your chips, it would be 100% tariff, and in like a year and a half, it would be 250% tariffs. And they could put all the tariffs in the world, but the fact of the matter is it just takes too long to build the fabs, the things that create the chips. So I think this is their way to try to ameliorate the defense issues that so clearly are there. I don't like it. I'm a capitalist. Don't want, make regulations. That's all. That's the job of the government. Don't own companies. But here we are.
And we are starting to see some of that. We are starting to see some of these companies based outside the U.S. build factories here. As Kim said, there's a time, right? It takes time to build these things. So, but they are kind of heading off that issue. So it'll be interesting to see how this plays out.
Well, we played about all we can play out at this moment. We're out of time, so we'll continue our look at investing in the economy in future editions. And since you're watching or listening to this particular podcast, I ask that you hit the like or the subscribe button on whatever platform you happen to be using. But for now, thanks for joining us. We'll see you again in about 2 weeks for the next edition of The Bull, the Bear, and You.